Afternoon. Today I want to talk about auditing of the statement of financial position. We do understand that the financial statements and the statement of financial position formulates part of the financial statements other than the statement of cash flows, the statement of profit or loss. Right, before we go into the audit of of the statement of financial position, we want to look at the financial reporting sense. Right, when you're talking about financial reporting sense, we want to look at the accounting equation where we are saying assets are equal to equities plus liabilities. That accounting equation is what formulates the statement of financial position. As you can now see these days, the new presentation of the statement of financial position actually says assets are equal to equities plus liabilities, other than long back where it was assets minus liabilities are equal to equity. Now, we also want to recognize the criteria. When you're talking about the statement of financial position, when you're looking at the assets, the equities, and the liabilities, what criteria are we using to identify these things? These items. We are looking into the recognition criteria. What are we recognizing? In recognition, we are saying, is it truly an asset or is it truly a liability? For example, a motor vehicle to someone or to a certain organization, a motor vehicle is an asset. To another organization, they don't view that motor vehicle as an asset. They view it as a liability, depending on how they define that asset or depending on how they define that liability. That's how they are going to recognize it in the statement of financial position. So that means the asset or the motor vehicle, when it falls under an asset, we are saying it has been recognized as an asset by the organization. Or when it falls under liabilities, we are saying it is recognized as a liability by the organization. Then we go on to measurement. How is this asset measured? Is it measured with the net book value? Is it measured with the replacement cost? Is it measured with the revaluation cost? Or is it measured at cost or even market value? Then we go on to the disclosure. How is it being disclosed in the statement of financial position? Or rather, besides talking about the statement of financial position, where is our asset being disclosed? Is it being disclosed in the statement of profit or loss, or is it being disclosed in the statement of financial position? Now coming to the audit, right, of statement of financial position items. What do we find in our statement of financial position? We find non-current assets, we find current assets, we find equities, we find non-current assets, and we also find current liabilities. What do we have as non-current assets? The machinery, the motor vehicles, and the buildings and the land. Then now what formulates our current assets? Inventory, bank, cash, trade receivables, and the prepayments. Then how do we what is our equity? Our capital, our ordinary shares, our preference shares, our share premium, our reserves, our retained earnings, and in certain circumstances of sole traders, the profit figures. Then how do we recognize our current liabilities? Long-term loans and debentures. Current liabilities, trade payables, and short-term loans. So those are the items that we are going to mainly see in our statement of financial position under the stated headings. Then our non-current assets. What is a non-current assets? We said we want to look into the audit of statement of financial position items, but we are not going to look into the other items like the current assets, equities. No, today we just want to look into the non-current assets. What is our non-current assets? In fact, why should we be interested in non-current assets? Because we are saying they formulate the major value of the statement of financial position, right? Or of the financial statements. They constitute a significant amount of money or financial terms to the financial statements. And due to their value, we should give them attention as auditors, the non-current assets. The purpose of an audit is to enable the auditors to formulate an opinion on whether the financial statements are true and fair. And in doing that, the auditor is to satisfy himself or herself that the internal control systems that have been used in the preparation or in the overall organization are reliable. Then the auditor should also satisfy himself that materiality of the amounts involved are valid, right? When you're talking about materiality, we are talking to the extent of significance. How significant is the value going to impact on the decision? Then we will look into the current professional practices. How do we practice as an organization? In what industry we are as competitors, or maybe as people who are new within the field. Then also look into the risk and absence of suspicious circumstances. All this formulates in how the auditor is going to come up with an audit opinion in terms of the audit of non-current assets. Then the auditor's objective when it comes to verification of non-current assets are as follows. Number one, the auditor is going to look at the cost of the asset. What are we saying? We are saying, is the cost of the asset fair? Fair to what extent, right? For example, we buy a motor vehicle, maybe let's say a Toyota Hilux, a double cab, for 56,000 US dollars, right? When we are saying, is it fair? We are saying the same cost of that motor vehicle that we have bought should also relate to the same cost, maybe when we compare competitors that are selling the same motor vehicle, or when we compare some other industries or organizations that have the same motor vehicle. We should not see our motor vehicle costing 56,000. Then we go to another seller, then we find that that same motor vehicle, same manufacturing date, same usage or mileage has maybe a lower cost, maybe it's not costing 23,000. And they are the same car. So we are saying, is it fair? Then we go on to say, is it consistent with the cost of such an asset? When you take a motor vehicle, a Toyota Hilux, we are saying it's 56,000. Is this consistent with the competitor? Yes, it should be 56,000. Then number two, we go to authorization. Authorizations into acquisition, authorizations into usage, and authorizations into disposal. We are saying when the asset was being acquired, were there proper authorizations for acquisition of the asset? For example, in certain organizations or big organizations, right, for an asset to be bought, they should be a meeting. People come together, they meet and discuss on whether they should buy the asset, for what purpose that they should buy the asset, and to whom that asset is going to benefit. So was it authorized to purchase that asset? Did people meet? So which means we should actually have valid minutes for the meetings that happened for us to purchase the asset. People agreeing, justifying the need for the asset. Then we go to authorization for use, right? Since it was bought under an agreement, they should also agree on how the asset should be used, right? Who should use the asset? How should the asset be used? And who should benefit from the usage of the asset? For example, that Toyota Hilux, it was bought for the manager, right? So that the manager can, maybe it was a pack. It is a sentiment of motivation for the manager so that he can easily come to work, right? So the authorization as per acquisition, it is going to be used by the manager so that the manager is motivated to do more things within the organization, so that the manager can use the car for his personal use to come to work, right? That is an authorization for use. Or probably it's a motor vehicle that has been authorized to be used maybe in one of the departments within the university, right? Is it serving that department? Probably it's that department of what you call this, artificial insemination. Is the motor vehicle being used to go and for field trips to inseminate animals, right? That is the authorization for usage. Then we come for authorization for disposal. In terms of disposal, we are saying certain organizations, they have to come up with ways on how to dispose the asset. Some of them, they just follow the depreciation method, right? After its useful life, maybe 4 or 5 years, the asset is now a zero rated asset, right? So probably they've used the reduce and balance. It's no longer in their books, and they are going to sell that asset at zero cost. Or probably they're using a straight line method, right? Disposal. Maybe the market value then, the asset you bought it for 56,000, maybe the market value then will be 10,000. So when we dispose the asset, we are agreeing that we are going to dispose it at 10,000. But it also goes as far as to whom are we going to dispose our asset to? Are we going to give the manager that asset and buy him a new asset? Or are we going to take the asset from the motor vehicle, from the manager, then we sell that motor vehicle, then we take the amount and put it as part and parcel of replacing the new motor vehicle. Number 3, we come to valuation. Is the asset properly valued in the financial statements? Right. We are saying, how did we measure our assets in our financial statements? Did we measure the motor vehicle at cost, or did we measure the motor vehicle at market price? Probably it is appreciated in value, or probably it just had an accident, which means the value of the asset is going to drop. First, it was 56,000, then the value of the asset dropped because of an accident. Now it is now costing 12,000. So we should also recognize that when we are measuring the asset and disclose that information within our financial statements. Then we come to number 4, existence. We are saying, is the asset physically there? As auditors, we should satisfy ourselves by physically identifying the asset. It might be an asset that is listed in our books of accounts. As auditors, yes, the asset has been disclosed. We agree, but we have to go and see the asset physically. Because possibly you are trying to audit something that is not even there, or possibly you are trying to audit something that is there, but it is not even moving. Probably, which means it's also going to affect the value of the asset. Then we are going to go to beneficiary. To whom is that asset benefiting? Is the asset being used for the benefit of the entity? Coming back to our example, we said we are going to purchase a motor vehicle for the benefit of giving a manager. You see, I've already defined beneficiary. The manager is going to benefit so that he is motivated. So which means if the manager is motivated, then we are going to exploit the manager as an organization to the full extent. So we are benefiting from the exploitation of the manager. Number 6, ownership. Who owns the asset? Right. And in whose name? As auditors, we are going to verify the, maybe in this case, if it's a building, we would want to see the title deeds. If it's a motor vehicle, we want to see the motor vehicle registration book. In whose name is the motor vehicle registration book? Then you say that person is the owner. If the registration book is in the name of the organization, then the organization owns the motor vehicle, which means anything that succumbs to that motor vehicle, as the owner, we should either, if it's maintenance, repairs, we should repair the motor vehicle and maintain the motor vehicle because we own that motor vehicle because it is ours. Then lastly, number 7, presentation. Is the asset properly classified in the financial statements? Where is our asset presented? Is it presented as an asset in the non-current asset section? Or is it presented as a liability? Or is it presented as equity? According to IFRS number 1, the preparation and presentation of financial statements, right? When you're in the asset section, that's where you see the non-current assets in the statement of financial position. So what is the procedure for verification? Do not forget that we are mainly concerned. For example, when I'm examining you this question, I'm mainly concerned to see if you are catching up to the itemized words, the procedural words that are within. For example, if you look there, there's examine, inspect, right? Those are the keywords that we are looking into. So at cost, this is done for assets acquired during the year under audit, right? The auditor examines the purchase documents of the purchasing procedure to see whether they are transparent. The auditor inspects if there was objective selection of the suppliers and of the quality of the product, whether it is consistent with the price. The auditor also examines if the purchase was properly accounted for as capital and also not as revenue expenditure. And in terms of hire purchase, what do you think hire purchase do? What happens in hire purchase? How do we examine our assets as auditors, right? We go to the costs and the current and future payments. That is how we recognize the cost of the asset as auditors. Then authority. The auditor is there to observe the authority levels. For example, when purchasing certain items of a higher cost, a certain number of signatures of people in certain higher levels in the organization are used as authorization. The auditor also examines how the asset was used and also disposed. Valuation. The auditor must satisfy himself that the asset is disclosed at fair value in the financial statements. Fair value may differ from the original cost, but the auditor must satisfy himself that the value disclosed is justified. Why is that? Why is that they were saying the fair value is different from original cost? Because we are saying the asset maybe is appreciated or is depreciated in value. What considerations do we have that can affect the asset? Improvements on the asset, location of the asset, impairment of the asset, obsolescence of the asset, market value of the asset, or rather, in certain circumstances, consistent application of adopted principles that relate to the assets. So we are saying if our motor vehicle, that Toyota Hilux that we were speaking about, is improvements, it's no longer costing 56,000. Probably we have improved our asset. We have put in maybe bulletproof windows. We have put in maybe a lightweight body and so forth. Now it goes maybe as high as 120,000, right? Or maybe the location. Where is our asset being used? Is it being used in the CBD? Or is it being used in the raw areas? Due to the terrain there, the asset drops in value. Due to the terrain here in the CBD, the asset also has a certain value towards it. Then in terms of impairment obsolescence, you should know that the 2017 Toyota Hilux does not cost the same as the 2020 Toyota Hilux. Then we go to existence. The auditor should rely upon physical identification of the asset. Physical identification will help to determine the state of the asset, the location, and any other improvements. By state, we are saying by physically viewing the asset, you can now tell whether the asset is in use. Probably the asset has been disclosed in the books of account, but the asset is rather maybe it was crashed. It's no longer in use. But so as to cover up, we still record it in the statement of financial position. Then beneficiary and ownership usually are related, right? The order is to prove that the assets are owned by the organization and they are used for the legitimate purpose of the entity. We should also give reference to title deeds when they are buildings, registration books when they are motor vehicles, serial numbers when they are other assets that have serial numbers. So as auditors, you should see the title deeds, you should see the registration book, you should see the serial numbers. If the use of the asset gives rise to the benefit or expense, the vouching of the benefit of the expense will provide sufficient evidence of both ownership and beneficiary. Then we are just saying, right, we are going to benefit from the asset, use of the asset. So if you go ahead and service that asset, that means we are saying it is our asset which is benefiting us as an entity. An asset should be verifiable, it should have verifiable income, regularly emitted, and identifiable expenses for the general upkeep. Ownership and benefits from the asset should be attached to benefit enjoyed as well expense incurred in the use of the asset. Then lastly, presentation. How have we presented our financial position item, the non-current asset? Is it presented in the asset section or is it presented in the liabilities section? But we have covered all that because we have recognized the asset, we have measured the asset. So how are we going to present it? We are going to present our non-current asset in the statement of financial position in the non-current asset section. We're going to do it in according to IFRS number 1, the preparation and presentation of financial statements. The presentation should also show the fair view. It should be consistent from year to year and year to year. Right, this is a tutorial question that you guys should attempt. Ruby Motors has called you for the annual audit. Their line of business is buying and selling motor vehicles, but they also have pool cars that the organization uses in their day-to-day running. Required: A, state the audit objectives associated with the verification of the non-current assets. Then B, outline the substantive testing procedures you would perform to achieve the objectives in A. I'll be looking forward to your answer. Please give me your answer. Thank you.